Welcome to another edition of M&A Corner. I'm joined today by Peter da Silva Vint, a managing director at Jasper Street Partners, which is a specialized advisory firm focusing on high-priority matters that impact long-term value creation, shareholder engagement, proxy voting, activism advisory, and corporate governance. Peter, thanks for joining me today.
Thanks, Doug. Happy to be here.
Let's set the table a bit. We've seen a continued rise in activism over the last several years, really peaking last year with approximately 875 campaigns, both long and short campaigns. That's continued into this year with a particular rise in short campaigns in the early part of this year. The campaigns have been targeting reasonably familiar themes: financial performance or the lack thereof, board composition, and most recently, ESG themes, originally pro-ESG and now anti-ESG. Let me start by asking you, what trends are you seeing?
It's a great question. I think leading into Q1 of this year, some of the trends that we saw emerge last year, one was the proliferation of smaller activists. Many of them had cut their teeth at the more brand name, larger ones such as Elliott or Trian. They've kind of come out with a bang. They've targeted companies of all market caps. They've been super aggressive. They've been super successful. Another trend we saw was a record number of CEO departures. Traditionally, activists didn't really focus on CEOs. Shareholders seem to be less willing to support an activist targeting CEO, but that trend seems to have shifted in the opposite direction. And I think the other thing we've seen is activists have become more emboldened. They're going after larger targets, and their asks have also become more aggressive. So instead of asking for a handful of seats, they're asking for all of the seats.
That's pretty atypical, isn't it?
Yes, I think traditionally shareholders weren't comfortable with ceding control to what people thought were short-term minded investors. Over time, they've proven themselves to be more credible to the BlackRocks, the Vanguards, the State Streets, as drivers of change, as catalysts to drive change, where these large shareholders they can only vote. They can't vote with their feet. And this is a way of exactly that type of change.
So that reminds me of the expression constructivist versus activist. And we didn't really touch on this yet, but is that really just the same thing with a different name? Is it still wolf in sheep's clothing, or do you feel like there really is a change with a constructivist mindset?
I think there's a change. I think, there's been feedback from large shareholders that proxy fights are distracting, they're a waste of money, and
They're super expensive.
super expensive. They've gotten more expensive over time. I think there is a class of activists or constructivists that they actually do come in and they do request a meeting and they do say, this is our thesis, this is where we see holes in your performance, prove to us why we're wrong. And if we're wrong, we're happy to kind of walk away. And so you're seeing more of that, but you still have sometimes, the only way to get change is to kind of go back to those old school roots.
Pivoting now to focus on the current environment. As we entered 2025, I think everybody anticipated a wave of traditional M&A stepping in. And while that has yet to materialize, as we're all waiting for a little bit greater stability and clarity in the administration, what it has caused is a tremendous amount of economic uncertainty in the current environment, a lot of market volatility. Does that empower activists to be more aggressive, or are they taking a back seat like the strategic acquirers?
I think it's the latter. I think activists, fundamentally, they are value investors and they think about things like other investors do. What we found is that they are on the sidelines. Year to date, live campaigns launched they're down about 30 to 40% compared to last year. So what you're seeing is they're kind of waiting for this noise to die down and there to be a little bit more certainty. There is a view, though, that post April 2nd, when we get more certainty on things such as tariffs, that the activists will come back out. Another one of these trends that we've seen that I didn't mention before is that activists have made this a year-round sport. So they're no longer beholden to annual meeting cycles. And so they can kind of announce themselves any time of the year.
So would you say that the activists are adopting new strategies to address the current environment? So have the strategies changed? Have the themes changed? Or is it more continuation of the same, but with the current market backdrop?
So what we've seen so far this year, last year you saw Elliott take multiple multi-billion dollar positions in companies and ask for change. We haven't seen that so much this year. Today you saw Starboard announce that they were running a proxy fight at Autodesk. Their $500 million stake in a $56 billion company. Earlier this week, Engine Capital announced a settlement with National Vision. The window had closed a few weeks ago. There was no mention of an activist in the stock, but they were able to hash out a settlement behind the scenes quietly. So things have changed a little bit.
What would you say are the key elements of an effective defense strategy?
I think being prepared is the most effective defense
What does that
strategy.
mean?
So, I mean, outside of having a well-performing stock price, I think it's organizing a team of advisors, looking inwards, where are potential gaps, in your governance profile, looking outwards, how are you trading relative to your peers, and then how do you think about, any sort of shortcomings? And then I think finally too, just knowing your shareholder base, engaging with them consistently, in what we call the off season, finding out what their pressure points are, and where they may have issues with you should somebody else come, unannounced.
I use the expression bringing activism in-house. And I think that's really critical advice, is having an objective lens for a management team to spend time looking at the company unemotionally, how an objective outsider might look at the company, and being comfortable enough to look at where those shortcomings are and proactively work to address those. I was also struck by something else you said, which is maintaining an active dialogue with your most important shareholders, but making that more of a continuous process versus episodic. So making it a regular part of your conversation with your institutional shareholders, making sure they understand management strategy. I don't mean to be putting words in your mouth, but is that the kind of thing you're talking about?
Yeah, and some of this engagement paradigm has shifted a little bit in the last month because the SEC has given new guidance on how these large shareholders can interact with the companies that they own. But traditionally, that's been the case, is that you are in front of them, you're offering up conversations, you are sharing your views on strategy and driving long-term shareholder value, because that's how they kind of see it, is that they're long-term holders of the company. They'll be there after you leave. They were there before you were there, so they want to see that you're a good steward of shareholder value.
Peter, you mentioned the recent SEC rule change regarding filing obligations. Can you expand upon that a little bit?
Yeah. So last month, the SEC issued guidance on 13G and 13D filers. So 13G filers are passive holders. So you think of the large institutional investors, BlackRock, Vanguard, State Street. What they do is they have large percentage of ownership, but they have no plans on exerting control or influence over a company. So they're engaging, they're talking about strategy, they're talking about governance, they're talking about environmental and social issues. And that's been the case for many years. So now, recently, the SEC is saying that engaging in those topics may be viewed as trying to exert control and influence on these companies. And so these large institutional shareholders may have to file 13Ds, which is what activists do. And what it's done is there's been a chilling effect on engagements. BlackRock and Vanguard paused engagements while they tried to digest what this meant for them. There actually was a large proxy fight last month where this happened in the middle of the fight just before the vote. And I think what they've come to the conclusion is, they will engage. They will give a disclaimer that they're not attempting to influence or exert control over a company.
So we've talked about what makes for good defense preparedness. Let's look at it from the other side. When you're seeing that companies are making mistakes, what are the most common mistakes you see? And I think that's helpful because if people understand what the most common pitfalls are, we can work proactively with clients to try and address those up front.
Yeah, I think the most common mistake, I guess the two most common mistakes are, one, taking it very personal. A lot of times you see a CEO where either he's the founder, he's been there for a long time, and he feels like these activists are trying to take the company away from him. Whereas, if you think about the fact pattern, it's not that different from any of their other campaigns. This is not a specialized, targeted campaign going after this particular CEO. I think that that's one issue. And then I think the other one is, like you mentioned before, ignoring the large shareholders, putting a lot of emphasis on maybe ISS and the proxy advisors and believing that a positive recommendation there is going to bail you out, because that's not the case. I think over time, these large shareholders have shown that they do their own research and they make their own decisions.
You mentioned in the defense preparedness phase, what companies should be focused on to avoid or prepare for an activist. In the unfortunate event, though, that somebody does receive a call, what would you say are the first course of action that a CEO or a board chair should take?
It's a great question. Yeah, I think the first step they should take is calling their friendly bankers at Mizuho Greenhill. I do think that every company has a bank, they've got a lawyer, but not necessarily a specialized bank or specialized lawyer, right? And so I think what they need to do is look long and hard at their advisor deck and see whether or not they need to supplement that, right? So calling a Jasper Street, where we specialize, where we're tactically targeting your shareholder base, looking at some of these law firms where this is their bread and butter, making sure that those people on board will optimize outcomes.
I happen to agree with you that the best response is a proactive approach where the board has a well-defined sense of the company's standalone intrinsic value. You've done the analysis on if it's a situation where somebody's advocating for a breakup, the sum of the parts valuation. And the worst time to have your back against the wall is to be facing those issues upon receipt of an inbound approach, which is why we're always advocating with clients that they're proactively reviewing those strategies.
That's right. That's the sound way to do things.
Peter, thanks again for joining us today.
Thanks, Doug.
It's such a rich and important topic. I feel like we could go on for hours, but don't have the time. And thanks again for joining us for another episode of M&A Corner. Please reach out to your Mizuho Greenhill banker to further discuss activism, preparedness, and response.